So let's say, for example, you buy a 50 strike call for 3.5. This 3.5, of course, translates into $350 on the single call option. Should the stock rise to $55 a share, the option would be worth at least 5. There'd be time value on top of that, but it would be at least 5. So now you pay 3.5, and the option is worth 5. And it would be worth a little bit more than 5 actually because of the time value. So now you have two opportunities to profit, as I've just mentioned. You can sell the options in the options market, or you can exercise the option and purchase the underlying stock. If you exercise, you buy the underlying XYZ at $50 a share for a total cost of $5,000 plus the $350 you paid for the call. You then sell the shares of the stock for $5,500. Remember, it went up in value, yielding a net profit of $150. In other words, you paid $350 on the call, you made $500 on the transaction. The difference is $150 minus the commissions. Or you can close out your position by simply selling the option for $550 and collecting the difference between the premium received and paid. So you get $550 back. You just bought the option for $350. The net is $200. Puts work the opposite way. They provide a more attractive method than shorting stock for profiting on stock price declines, in that with purchase puts, you have a known and predetermined risk. Now, I don't know if you've ever sold stocks short before, but it's a little trickier than buying them. First, you need an uptick to do it. Second, your broker has to go out into the market and find someone who wants to let you borrow the stock. The risk, of course, is if the stock goes up, because you're obligated for the whole move. So if you short a stock at 20 and it goes to 25, you're out the 5. If you short it at 20 and it goes to 15, you just made 5 because it's gone down. In the case of buying a put option, you're only out the cost of the put premium. If it doesn't go down, you're out the premium. But if you short a stock, it can go to infinity and you're liable for the whole thing. Of course, there's a way out of it, as there are in all these transactions, and that is to go into the market and buy it back. But if you got to buy it back higher than you sold it, of course you have a loss. Another advantage of buying puts results in you're paying the full purchase price in cash the time the put is purchased. When you short stock, you got to put up margin. You got to guarantee the position, and believe me, your broker will come after you if the stock soars in value and you're short that stock. For example, you purchase a 50 strike June put for $4 or $400 for the put. If the stock falls to 45, the put option's worth at least 5 now, because you have the right to sell it at 50. It's at 45. There's a $5 difference. And to take profits, you can buy 100 shares of the stock at 45 and simultaneously exercise your put option, or you can simply sell the put option in the market. Most traders, as a practical matter, simply sell the options in the market. And the reason is, why pay extra premiums in buying and selling the stock in addition, unless you have some reason to want to own or be short that stock. So you can sell your put option contract, collecting the difference between the premium paid and the premium received. Options allow you to participate in price movements without committing the large amount of funds needed to buy the stock outright. As we're getting to the end here of this, I'll stop now, and then when we come back, we'll talk about in, at, and out of the money options. Let's talk briefly about in, at, and out of the money options, because we're going to be using these terms when we get into the strategies. It's important that you understand the difference between an option that's in the money, at the money, or out of the money. And remember, calls work in the exact opposite of puts. A call option is in the money when the underlying asset is trading above the strike price. In other words, if you have a strike of 20 on the call and the market's at 25, it's in the money. If you have a strike of 20, the market's at 15, it's out of the money. If you have a strike of 20, the stock is at 20, it's called at the money. As the name suggests, an at-the-money option is trading more or less where the underlying is traded. So if it's at 19 and a half, and you have a 20 strike, that's considered the at-the-money option. If the market's at 20 and a half, and you have a 20 strike, that's considered at the money. But if you have a 20 strike and the market's at 30, it's definitely in the money. And the same thing, if the market's at 10, it's definitely out of the money. In the case of a call, an out-of-the-money option has a strike price that's above the underlying asset. Puts work in reverse. With a put, you want to strike well above where the market is, because the put is giving the buyer the right to sell the option. So if you have a 20 strike put and the market's at 10, it's in the money. If you have a 20 strike put and the market's at 30, the put is out of the money. So before we get into the strategies here, let's go over some of the things we've talked about. There are trade-offs in every single strategy we're going to talk about. There's always a pro, there's always a con, there's always an advantage, a disadvantage to every strategy. You need to know this before you undertake the strategy and you put your money on the line. You need to understand the theory, you need to know the point of break even, you need to know the maximum profit if there is one on your strategy, and of course you need to know the risks. As I said before, there are strategies for every single type of market you can dream of. Bull, bear, sideways markets. They can be complicated. If the strategy is too complicated, or you feel it's too complicated, or you feel you don't understand it, the way to go about understanding it is to go back and say, what do I have here? What does the call give me? What does the put give me? Am I a buyer? Am I or am I a seller? Always go back to basic strategies. What is a call? What is a put? How do they work? And then always ask yourself, what kind of a market am I in? And in particular, what's the status of the current stock, of the underlying stock of the option I want to buy or sell? Are you about to have an earnings report? Is there a lot of uncertainty about this stock? Is there a lot of volatility with this stock? Or perhaps the stock's been in the doldrums for months now and it's about to experience some volatility. There's a lot of different scenarios that you need to think about before you undertake an options position. What is the risk? And this is one of the most important things. A lot of new people, especially in the market, don't want to think about the risk. But believe me, the professionals do, and they think about it all the time. I was a floor trader for 10 years in Chicago, and I can tell you the professionals think about the risk every single day. So they're constantly hedging their positions because they understand that no one knows where the market's going for sure, and just in case, they want to know what is the risk, where do I get out if I'm wrong. In addition, you want to be a specialist. You can usually tell a novice trader because he's trading everything under the sun. The professionals on the floor in Chicago only undertake typically one or two strategies, and that's all they do day after day after day. There's very, very sophisticated people in the options market. It's a highly mathematical type proposition, and they know the math. There are a lot of PhDs in math in Chicago devising options strategies. So they know what's called the fair value of an option, and this is a price you can get from your broker. You can ask them, what is the fair value of this option before you buy it or sell it. Obviously, you want to buy an option that's trading below fair value, and you want to sell one trading above fair value. And I'm not suggesting here in covering the 21 that you should even think about doing 21. You should do one or two or perhaps three at the most, but find strategies you like and stick with them. Now, the exception to that is when the market changes on you, and this will happen from time to time. You'll go from a screaming bull market to a screaming bear market, or a market that's in the doldrums. There's not going anywhere. Well, you have to adjust your strategies accordingly in that situation. And I mentioned this, but remember, you're competing with specialists all the time. There's two parties to every trade. If you're buying, there's somebody selling to you. He's selling to you because he thinks you're wrong. or because he's got another, or he's hedging a position, he doesn't mind losing. Let's go back to the example of the insurance company that sells you insurance on your home. They're betting that over time there will not be a catastrophe and they'll get to keep the insurance premiums you're paying them. And you're hoping that they're right, actually, because you don't want your house to burn down or to be flooded out or to have wind damage from a hurricane. So there's two parties to every trade, and they both have their interest at heart. So you're competing with the experts. I've said that options can be a hedge. Now, they may be a hedge for the person on the other side of the transaction you're taking. They can be a hedge, they can be very speculative, or they can be very conservative, as I mentioned. But always ask yourself, what is the positive, what is the negative, and start with the basics. And we'll start with some of the very basic strategies here, and there again, we will build on them. But by the time we get to the end, where instead of just buying a call or buying a put, we've got 3 strike prices in the case of a butterfly, perhaps even 4, and you're long some and you're short others, it gets complicated. You don't want to have any surprises.